Just a few years ago, Nissan was one of the biggest names in the global automotive industry. Its vehicles were known for affordability, reliability, and mass market appeal. But today, a surprising situation is raising eyebrows across the auto industry. Tens of thousands of Nissan vehicles are reportedly sitting unsold at ports, storage facilities, and dealership lots across the United States. Some reports suggest the number could be as high as 80,000 vehicles. The question is simple: how did one of the world's most recognizable car brands end up with such a massive inventory problem, and could this lead to some of the biggest discounts consumers have seen in years? At first glance, having too many cars might not sound like a major crisis. After all, automakers build vehicles to sell them. But in the automotive business, inventory is a delicate balancing act. When vehicles sit unsold for weeks or months, they begin costing manufacturers and dealers money. Every parked vehicle represents capital that has already been spent on production, transportation, storage, and financing. The longer those cars remain unsold, the bigger the financial burden becomes. What makes Nissan's situation particularly interesting is that this inventory buildup is happening during a period of major transformation in the automotive industry. Consumer preferences are changing rapidly. Electric vehicles are gaining attention. Interest rates remain significantly higher than they were just a few years ago. Monthly car payments have reached levels that many consumers find difficult to justify. As a result, demand for certain vehicles has cooled dramatically. For Nissan, the challenge appears to be a combination of several factors occurring at the same time. The company has spent years trying to rebuild its image after a period of corporate turmoil and leadership controversies. While competitors aggressively expanded their hybrid and electric vehicle lineups, Nissan's product strategy often appeared slower and less aggressive. Although models like the Rogue and Sentra continue to attract buyers, some analysts argue that Nissan has struggled to generate the same excitement that competitors such as Toyota, Hyundai, Kia, and Tesla have created in recent years. The inventory problem becomes even more significant when viewed through the lens of dealership economics. Dealers typically finance their inventory through what is known as floor plan financing. In simple terms, they borrow money to keep vehicles on their lots. As interest rates rise, the cost of holding unsold inventory rises as well. A vehicle sitting on a dealership lot for months is no longer just taking up space. It is actively costing money every single day. This creates a dangerous chain reaction. Manufacturers continue producing vehicles to keep factories running efficiently. Dealers receive those vehicles even as customer demand slows. Storage lots begin filling up. Ports become crowded with vehicles waiting to move through the supply chain. Eventually, the entire system starts experiencing pressure from excess inventory. For consumers, however, this situation can create opportunities. Historically, when automakers face large inventory buildups, they often respond with aggressive incentives. These can include cash rebates, low-interest financing offers, lease deals, bonus discounts, and dealer incentives designed to move vehicles quickly. The goal is simple: convert parked inventory into cash as fast as possible. This is why industry observers are paying close attention to Nissan's inventory levels. If the reported backlog remains high, the company may have little choice but to offer increasingly attractive deals. Automakers generally prefer selling vehicles at lower profit margins rather than allowing inventory to remain unsold for extended periods. Unsold inventory ties up resources and creates pressure on future production planning. But there is another layer to this story that many people overlook. The automotive market today is far more competitive than it was a decade ago. Traditional manufacturers are no longer competing only against each other. They are also competing against rapidly growing electric vehicle companies and aggressive international brands. Consumers now have more choices than ever before. If one manufacturer fails to capture attention, buyers can quickly move to alternative options. Toyota continues benefiting from its strong reputation for reliability and fuel efficiency. Hyundai and Kia have dramatically improved their designs, technology, and warranty programs. Tesla remains a dominant force in the electric vehicle segment. Meanwhile, Chinese automakers are expanding their global presence and creating additional competitive pressure across multiple markets. Against this backdrop, Nissan's inventory challenge becomes more than just a temporary sales issue. It raises broader questions about product strategy, brand positioning, and long-term competitiveness. If consumers are choosing rival brands at higher rates, discounts alone may not fully solve the problem. Price cuts can move inventory, but they do not automatically rebuild brand momentum. There is also the issue of consumer psychology. When buyers hear that a manufacturer has thousands of unsold vehicles, some interpret it as an opportunity. Others see it as a warning sign. Potential customers may begin wondering whether newer models are coming soon, whether resale values could decline, or whether the brand is facing deeper challenges. Managing public perception becomes just as important as managing inventory itself. At the same time, Nissan is not alone in facing market headwinds. The entire automotive industry is navigating a period of uncertainty. Inflation has affected household budgets. Financing costs remain elevated. Many consumers who purchased vehicles during the pandemic-driven supply shortages are now delaying replacement purchases. The result is a market where inventory levels are gradually increasing across several manufacturers. Yet Nissan's reported backlog stands out because of its scale. 80,000 vehicles represent a substantial amount of inventory. Even for a large global automaker, that number attracts attention. It signals a mismatch between production levels and consumer demand that cannot be ignored indefinitely. The coming months could therefore become extremely important. If demand strengthens and inventory begins moving more quickly, the situation may stabilize without major disruption. However, if inventory continues accumulating, pressure for larger incentives could intensify. Dealers may push for additional support. Manufacturers may adjust production schedules. Promotional campaigns could become more aggressive. For buyers considering a new vehicle, this environment may create one of the most favorable negotiating periods in recent memory. Dealers facing inventory pressure are often more willing to discuss pricing, financing terms, trade-in values, and special incentives. Consumers who research carefully and compare offers may discover opportunities that were difficult to find during the supply shortages of previous years. Still, the broader significance extends beyond discounts. Nissan's inventory challenge serves as a reminder of how quickly market conditions can change. Just a short time ago, the industry was dealing with severe shortages and limited supply. Customers were paying above sticker prices, waiting months for deliveries, and competing for available inventory. Today, the conversation in some segments has shifted toward excess supply and growing inventories. That dramatic reversal highlights the unpredictable nature of the automotive business. Consumer demand can change rapidly. Economic conditions can shift unexpectedly. Competitive pressures can emerge from new directions. Companies that fail to adapt quickly often find themselves facing difficult decisions. As thousands of vehicles remain parked and waiting for buyers, the industry is watching closely. Will Nissan successfully clear its inventory through strategic pricing and incentives? Will consumer demand return strongly enough to absorb the excess supply? Or does this backlog point to deeper challenges that could require a broader transformation of the company's strategy? The answer may determine not only Nissan's performance in the coming years, but also provide a glimpse into the future direction of the global automotive market. One thing is certain: when tens of thousands of vehicles are waiting for buyers, the story is no longer just about cars. It is about economics, competition, consumer behavior, and the constant struggle for survival in one of the world's most competitive industries. The vehicles are already built. The inventory is already sitting there. Now the only question is whether buyers will arrive before the pressure becomes impossible to ignore.